Hey everybody, Melanie Atkinson, Realtor with Smith & Associates here in beautiful Tampa Bay, Florida. And recently I had an interesting conversation with a lender friend of mine about mortgage interest rate misconceptions and refinancing. Take a listen. Hey David, so this is David Donaldson. He is a lender with VanDyk Mortgage here in Tampa Bay, Florida. And we are going to chat with him today about what's going on currently, about refinancing, about interest rates and everything else. So how are you doing today, David?
I'm doing great. Managing like everybody else is, staying home, trying to
Yeah.
to stay safe and healthy.
Yes, I can see you're at your house right now. So matching greens there. Um, okay, so let's give everybody a quick update of what's been going on with the mortgage lending market in the last week, because it's been a bit of a roller coaster, hasn't it?
It's been a little bit of a roller coaster for the last month. The great news is that we have hit all-time new lows on interest rates, and people are taking advantage of that through refinancing. We have probably 3 times as much business as we normally do because of that. We have seen rates bounce up and then back down because the government is doing different things that are causing a reaction to the interest rates. A month ago, I think we are probably around 4% on a 30-year fixed rate. This health crisis started. A lot of people were getting out of the stock market and buying mortgage-backed securities, creating a demand, and rates went to 3.125. Then the government came out with some stimulus, creating a need to get more debt out there in the marketplace without enough buyers. So all of a sudden, rates went up above 4%. And that was last week. This week, the Federal Reserve came out and said they're going to buy 50 billion with a B dollars worth of mortgage-backed securities every day this week. That's a quarter
Wow.
of $1 trillion. It's huge. It's massive. So Friday we were at 4.125, and today we're at 3.375, headed to 3.25, which normally we have. I mean, it takes a whole week to move the interest rate an eighth of a percent. So having it go from here to here and back is not normal by any means. But the
Right.
benefit for anybody who's watching, if they own a home, I mean, it's a fantastic opportunity to look into refinancing or potentially investing in real estate because the rates are so low.
Right.
Your buying power is more, and we can discuss that too. But
Yeah, I definitely want to discuss buying power. So let's talk about refinancing since that seems to be the hot thing right now. What are your general rules for refinancing? If someone locked in, say, back in 2018 when rates were in those mid four, upper four ranges, and we thought things were going to be going up from there, how much lower should the rate be for them to consider refinancing?
it depends on the loan amount. There's a cost to refinance, and some of those costs are fixed. Lender fees, title closing fee, the appraisal fee. It doesn't matter whether the loan amount's 100,000 or 400,000. Those things are fixed. So when you're saving a full 1% spread on 100,000, the first year you'll save $1,000 in interest.
Okay.
But a 1% spread on a $400,000 loan, you're going to save $4,000.
Okay.
So someone who is at 4% on a $400,000 loan can refinance to 3.5, and it makes perfect sense. Somebody on a $100,000 loan, it may not.
Okay.
Um, Everybody's situation is just unique. They need to talk to a mortgage professional to see what the benefits are. We have people that we are refinancing out of PMI insurance because values have increased from where they bought the house 3 years ago. And that right there could save 80, $125 a month or more, as well as an interest rate that goes down a quarter percent, or
Right.
half a percent. Um, there's a simple calculation of I'm going to save this much interest each year, and then there's a cost where those two lines cross. Say it's 2 years down the road or 3 years down the road. If you know you're going to be in the house for the next 5 years, great. If it's going to take 4 years to recoup that money, and we deal with a lot of military personnel,
Right.
here. And so they move about every 5 years. They've been in the house for 2 years. They're probably not going to be in the house for 5 years. Then no, you don't need to refinance. So
Right.
anybody who purchased a home in 2018 or 19 should be calling a lender to refinance, because it probably makes sense because of
Okay.
where rates were, back at that time.
Yeah, I remember. And we thought they were great then, and they were great then from a historical perspective. So this is
Sure.
just such a strange time right now. So, okay, so we've talked about refinancing a little bit. So let's talk about people buying new. So you have a couple of my clients currently in the process of getting a loan. One of them is new construction, and you have advised him not to lock in right now. Because rates are all over the place. So explain to me how you advise people on when they should lock in when they're currently buying a house.
So the lock-in periods can range from 15 days up to 6 months. Typically, you get the best interest rate for a 60-day lock-in period or less.
60 days or less. Okay.
Yeah. So like today, a 30-day lock-in may be 3.375. A 60-day lock-in is 3.5. You go to a 6-month lock-in, it might be 3.75, and you have to pay a 1 point origination fee.
Okay.
So the longer the time frame is, the higher the rate. So we expect that rates are going to remain low for the next several months. We might have some daily or weekly volatility within that, but we can catch it at a good time appropriately, and that gets us closer to the closing date. Now, if we have people that are closing within 60 days, we're trying to lock them in right now. People that were refinancing, we weren't talking to for about 10 days because rates went up. And
Right.
yesterday we were on the phone all day with them, explaining what was going on, where we were at, and agreeing to get the rate locked in. At this point, same thing with buyers. I mean, we've had rates fall 0.75% in 2 days. It's a good time to lock in.
Right.
So yeah, yeah.
So
But
we aren't expecting rates to be zero. I think people hear the news and they see that the government has lowered the interest rate to zero, but
it's not.
that's not the same for
Yeah,
mortgages.
it's
Explain
not.
why that's not the same for mortgages.
So what the Fed did was lower the prime rate, what's commonly called the prime rate, and that is the rate that banks pay the Fed or each other to borrow money overnight to create liquidity. Those rates are overnight rates, not 30-year fixed rates. They are tied to credit cards, car loans, home equity lines. So a home equity line was 4.75 month and a half ago. That was the prime rate. And the Fed has lowered the prime rate by 1.75%, which is that bank rate at zero, but that's not what we pay because we're not the banks, we're the consumers. But that rate has come down to 3.25. So if you have a home equity line, you're paying 1.25% less this month than you were last month in interest. So there's a benefit there, which is why the Fed did that.
Right. But
Yeah.
mortgage rates will never be
No,
zero.
no, never.
That would be crazy for the real estate market if it was.
It would be wonderful if it was. But yeah, the mortgage rates are set by markets that have investors who are willing to purchase something and get a return. You can go put your money in the stock market, which has a much higher risk tied to it, but may give you a higher return. Or you can put it in US Treasuries. The 10-year Treasury is paying somewhere between 0.75 and 1.25, depending on what's going on in the market. So, if you've got $100,000, you'll, get 1,025 back, 1,250 back over 10 years. Now you can go put it into a 30-year mortgage-backed security at 3.5%. So there still has to be an appetite for investors to buy this stuff. It's not just I get a home loan and it goes in a drawer somewhere. The markets work with people purchasing these assets that are created. So they'll never go to zero. And at some
Well, no one
point,
would buy them if they were zero.
well, and at some point you have Well, when the rates first fell and they got to 3% for a day, then they went to 3.125, and then they kind of bounced up to 3.375 like within 2 days. And it was because the investors are out there and they just like, stop. I don't want to buy 3% at 30 years. I'll wait a few weeks or whatever to give you my $100 million or 500 million or whatever it may be. So um, when they were down at 3.125, that is the lowest they have ever been. And I don't think we're going back there, but three and a quarter, 3.3, 3.5. I mean, those are great interest
Yeah,
rates.
those are amazing interest rates for a 30-year loan.
Yeah.
So when you say that the government is buying $50 billion worth of mortgage-backed securities per day, what does that do? Does that help keep the interest rates low?
It does. It created an artificial demand for the product. And it's just like, well, similar to when you're selling a house. If all of a sudden you've got four people interested in the house and they're all trying to put a contract offer on it, the price is probably going to go up or the terms are going to be better, something's going to happen. Same thing with mortgage-backed securities. If you have nobody out there interested in buying them, rates are going to go up. You create $50 billion of interest on a daily basis, the rates are going to come down because you don't need to have that return requirement. And I think they did this to provide some stability because you can't go from 4 1/8 to 3 1/8 to 4 1/4. We just need to get into a range. And so this artificial stimulus should create some stability in the interest rate market. There's too much stuff going on for you to say that they're definitely going to be there. I'm just saying that's what they intend to do, but
Right.
who knows what tomorrow will bring.
Right. So none of us know what tomorrow will bring. Hopefully, the interest rates will stay low and more stable. So buyers that are coming into the market know what they're going to get and aren't worried about locking in, thinking that it's going to go down another 3/4 of a point tomorrow. So at this point, we're assuming that it's going to be stable in threes somewhere, correct?
Correct. I would
For a while.
expect for the foreseeable future, I think that if you use 3.5 to 4% as a benchmark, we're good. Back in 2018, we were closing loans at 4 3/4.
Mm-hmm.
I can remember refinancing people from 8.5% to 6.5%, and they were thrilled because the rate went down by 2.5%. And a year later, I'm calling them because they're at 5.25%, and then a year later, I'm calling them because they're at like 3.75. They're like, you can't do this. I'm like, the math makes sense to do it. I can't predict where interest rates are going to go, but here
Right.
they are. You need to take advantage of it. And that being said, rates are at that low level, whatever range you want to put on it right now. It's an excellent time to buy a house, and you should be looking at your personal financial situation and taking the time and effort. And there is some effort to refinance, your house because
Right.
these rates are historically low again.
So let's talk about buying. Obviously, we were going into the spring, summer buying season, which here in the Tampa Bay area is our very, very busy time. So if people have to move or they want to move during this time, even though there's a bit of uncertainty at this particular moment, um, what are we looking at as far as closing loans? Are loans taking a little bit longer because everyone's working from home and things like that? What should people expect for the loan process right now?
Well, I can speak to what VanDyk is doing, and
Okay.
we are set up to where, other than essential executives, everybody's working at home and it's business as usual. We are operating as usual. You can go to my website, complete an application. You'll get an email directing you to the secure portal where you can upload documents. We can communicate through phone, text, emails. Underwriters are all logging in and getting the information and reviewing it, approving. The appraisals come in. So from a functionality standpoint, nothing has changed other than you're sitting in a different chair.
Right.
And I'm liking sitting at home, to be honest with you.
Yeah, I'm sure. It's a lot more comfortable.
Yeah, exactly. From the process standpoint, we are seeing a little bit of a slowdown with appraisals
Hmm.
because people are refinancing. You just can't quadruple business and still have the same number of skilled people who do these reports to give us what the value is and not expect a slowdown. So what used to take 7-8 days is we're anticipating 15 days. And so that's really the only hiccup there, where we used to close loans 30 days, no problem. Maybe we should be giving it an extra 10 days just because of the
Just to be sure.
situation that's out there.
Are you seeing any change with the need for appraisals from the Fannie Mae, Freddie Mac loans? Are they doing some no appraisal refis?
On refinances, we sometimes do get an appraisal waiver. Usually it's because there was an appraisal done within the last 2 or 3 years. And so whatever algorithm they put in there that makes them comfortable that they don't need another report. Certainly over the last 3 years, we've seen an appreciation in real estate. And so they're not worried about the value being less.
Right. So if someone bought in 2018, that was 2 years ago, and
Yeah.
in general, if they can do a drive-by and see that the house is still standing,
Right.
we can assume that the house value has gone up during that time, because just in general, house values have gone up during that time. So those might be the
Yeah.
cases where you would have an appraisal waiver.
Correct.
Okay. Well, that's important. Hopefully they do as many of those as possible to keep everything moving correctly for the home purchasers. Now, do you personally prioritize the people that are purchasing over people that are refinancing?
Yeah, we are locking in people to refinance for 45 to 60 days. And the quicker that they can get the documents to the lender really depends on that. I locked somebody yesterday for 45 days because he's Johnny on the spot and I have it in an hour.
Right.
Somebody else was 60 days because he's very busy running his business, and we'll get to it tonight, depending on how tired he is when he gets home and
Right.
all that type of stuff. But we're running 2 lanes. We have a purchase lane, and those are always going to take priority because there's a contract involved, deposits that are there, people getting moving trucks. We are going to meet that closing date. And so they're always going to take a priority. And then refinances are running alongside those, just simply in a different lane. So as a company, you cannot lock a refinance in for 30 days. It's 45 or 60. Take your choice depending on how your client is.
Okay. So let's talk a little bit about just in general what we're seeing now versus what we saw in 2008. I think a lot of people are very nervous. Uncertainty always brings about a lot of nervousness from consumers of all products. So the difference between 2008 today, we obviously understand that 2008 was a different set of circumstances, and today we are dealing with a health crisis that has an unknown economic effect at this point. So just give me your thoughts on all of that.
Well, I think you pretty much summed it up, in simple terms. I mean, I was there for the 2008, 2009 situation, and it was like somebody turned a faucet off from the lending side of things. And Countrywide, one of the largest banks and mortgage lenders in the country, I think they were the third largest bank. If you would have asked me 2 months prior to that in a casual conversation, do you think there's any way Countrywide could file bankruptcy? I'd be like, absolutely not. There's absolutely no way. Well, Countrywide was doing a lot of non-documentation type loans, crazy mortgages, negative amortization type loans. And they were selling that paper again to somebody who wanted to buy that debt, investors who didn't want the 3.5% rate. They're getting 5.5%, 6% on this paper that had things like, we don't ask you if you have a job. We don't care.
It was crazy, as illustrated in one of my favorite movies, The Big Short.
Yeah, that's exactly what it was. So all of a sudden, the investors realized that they were not buying quality paper and decided to stop. Well, Countrywide had already funded billions of dollars worth of stuff. They borrowed money to fund that. Now they can't sell the product and they can't pay back the loans. And just like that, they went bankrupt, which started the whole thing. So it was a housing crisis, too much available money, and it just kind of steamrolled into things. Right now, if you take the health crisis out of the situation. And where were we a month ago? Corporate earnings were at record levels. Unemployment was at an all-time low. Wage growth was happening. People were getting raises, making money. The stock market was, at all-time highs. For the month of February, real estate, the existing home sales and new construction starts were at a 13-year high.
Yeah, and
Everything
our
was good.
inventory was like at historical lows, which
Right,
then indicates that the prices would have continued to go up because we didn't have enough inventory so
right,
to even
right.
sell. So, supply and demand. Yes, I mean, personally, January and February were fantastic months. It's like the year started off just gangbusters,
Yeah.
and then all of a sudden it was an immediate stop. I personally have still had a lot of clients reach out. They don't seem deterred from moving down here. One, they might have to be moving down here. They either have a spouse that's already here and they need to get down during the summer before next year's school starts. Um, or they have just been planning on this move forever. So I don't see a lot of clients of mine at this point, and obviously we're just a couple weeks into all of this, that are saying, you know what, I can't move anymore. So I think, the economic part of it will unfold as time goes on. Um, but hopefully by keeping the interest rates lower and allowing people to hopefully save some money by refinancing. Oh, that's one question I had about refinancing. The costs that you were talking about regarding refinancing, can those be put back into the loan?
They can. You have to look at the loan to value to make sure that, as an example, if right now you don't have PMI insurance, you don't roll those costs in, you go above 80% loan to value, now you have
Yeah,
PMI insurance. So,
right.
but I have not had one where we're not rolling in those costs in the loan.
Okay.
And
So
I
it's
think
not like people are coming out of pocket to do it. It's a good way to save money if you haven't thought about the possibility of refinancing you are in that 4% range. Talk to your lender or call you to get some more information on whether refinancing is right for you, because you're not necessarily going out of pocket for a lot. Correct?
that's correct. I mean, you can basically show up at the closing table, bring a $200, or maybe you get a check for $200. We try to target it as close as we can, and that's about the spread of where we usually hit on it. And I'm happy
Okay.
to talk to anybody about refinancing. I only do loans in Florida, so I can't help somebody that's out of state. But anybody who's in Florida, I would love to be able
Okay.
to talk to them. And I think with the people that are moving or contemplating moving, the buying power for a purchase transaction has changed to where if you were in the $200,000 price range, you can buy for 225 and it's the same monthly payment. If you're at 400, you could go to 440, which opens up more markets. 375 to 400. I can't go above 400. I can't afford more than 400. Well, we can't find something for 400. Well, we can find something for 435 or something like that. So I think
Right.
it's creating, a different price point, which is opening up more option.
Yeah, I wanted to talk about buying power. So let's deconstruct that a little bit more, so people understand exactly what you're saying there, because that's a really important point. A lot of people, a lot of my clients talk to me in a monthly cost way. So they say, I want to stay under $2,500 a month. So from there, we kind of work backwards and we look at, the potential of taxes and HOA costs, and then what you can afford for your principal and interest portion of it, which typically is the biggest portion of your monthly payment. So what you're saying, by the interest rates being where they're at right now, is that portion, the principal and interest portion, can be larger because the interest is so much lower. So what you might have been able to afford last month when it was, or a couple weeks ago when it was in the fours or four, you can now afford more principal and interest.
Correct. So
That increases your buying power.
I was just using my phone for a calculator because I
Yes,
wanted to try
please.
to do it. So on a $400,000 house, um, because the interest rate's lower, the payment very well may come in, $325 less, allowing you to borrow, $50,000 more and go up in price because insurance is a little bit more and taxes are a little bit more
Hmm.
with that, to where you're at the same $2,500 payment.
Right.
So That's
But
that
yet you got the
basically.
house that you really wanted.
Yeah, or you got more house,
Yeah, that
Yeah,
you can grow
absolutely.
into.
Or you stick with the same price range, and now you're several $100s less on a monthly budget, and that's not bad either.
Exactly. No, all of those scenarios are perfect for people. And I know because you and I do a lot of loans together that thinking of it from a monthly budget perspective and then working backwards is really my favorite way to talk to people
Mhm.
about loans. And I know you do the same thing with everybody to help them understand all the components of their monthly payment and what they're going to be able to afford in different neighborhoods. In the state of Florida, we have a lot of different fees associated with certain neighborhoods, CDD fees and things like that are all part of the taxes, HOA costs and everything like that. So you, I know in particular, do a very good job of going over all of that and whenever they find a house or a neighborhood that they really like. So just wanted to tell all of you guys that he's very good at explaining all of that.
Well, thank you. Yeah,
You're welcome.
it is definitely. You could go from one subdivision a couple miles down the road to another, and the taxes in one subdivision because of a CDD fee maybe a couple $100s more a month than the one further down the road. So you have to manage that into the budget, and certainly there may be benefits from parks within the community and
Right.
tennis courts and stuff. So you figure that out with them, but we can definitely work
I
out.
figure that out. You figure out the other part.
Yeah,
Together we get it done.
correct.
Okay, so do you have any final thoughts regarding? I know anything that we put out there now could very well change tomorrow, so I don't need any predictions or anything like that. But overall, I know you're super busy because the refinancing market's doing good and people are still buying houses down here in Tampa, even with all of this going on. But do you have any thoughts, any encouraging words, or anything like that for everyone out there listening that may be a little bit nervous?
Yeah, there was. We've got a lot of different experts that we rely on that feed us information, and um, we have gone through financial crises before. We have seen dips in the stock market before. It's a natural thing for us to go into a recession, typically every 5 or 7 years, and it's the people hear recession, they're like, oh my gosh, the world's ending. It's not ending. It's a economic thing where there's 2 months of gross domestic product that shrinks, it contracts, and now you're in a recession. By the time you recognize you were in a recession, you're on your way out of a recession. And the stock market recovers. How quickly? We don't know that, but it's going to, recover. If you have 10 plus years to retirement, don't worry about it. It'll recover.
Right.
Um,
And people always need housing. That's one of the things that doesn't go away. Shelter is a basic need. So, that's one thing that's encouraging for people. I think, everyone's getting very nervous about it being another 2008. But 2008 was very much an anomaly in terms of how real estate is affected by recessions.
so from the 2008-9 situation, uh, there was governmental legislation that came out dictating how things are done. Your no income, no job, no problem loans are no longer out there. Anybody who has bought a house in the last 10 years qualified to buy that house. They had a job, they had money, they put money down, they had good credit, and that in itself is going to stabilize, things. Now, certainly some people are unfortunately going to lose their job because of restaurant or whatever, so they may have some struggles. The government right now is talking about helping those folks to relieve them, but the housing market and the people who live there or bought a second home or bought a house to rent are very strong people. And those situations haven't changed. They're just working from home.
Right. Yes, a lot of people are still working, just working from home. So, okay. Well, this has been very informative. Thank
Yeah.
you, Dave. It's nice to see your face since
Nice
it's
to
been a
see
couple
you.
days.
Yeah,
Uh,
nice to see you too. Everybody stay safe.
Yes. So if anybody wants information on how to contact David, we will have all that information in the about section of this video. Thank you guys so much for joining me, and I look forward to next time. With love, Melanie.
Have a great day.